Let's talk about another important concept in cost accounting, the difference between production cost and period cost. So, what are production costs? Those are the costs that are directly related to making a product. Imagine you own a factory that makes wooden chairs. The money you spend on wood, the people who build the chairs, and the electricity for the machines, these all are production costs. There are three main types of production costs. First, we have direct materials, which include raw material traceable to a product. Those are raw material you can easily trace to the product. For example, the wood used in chair manufacturing. Second, direct labor. These are the wages of the workers who actually build the product, like the person use tools to build the chair. And manufacturing overhead, which is those are the indirect costs related to production, like the electricity, use the power machines, or the cost of maintaining factory equipment. Now, here's an important point. The production costs are not counted as expenses right away. Instead, they are capitalized. That means they are stored in inventory in your company balance sheet. You only treat them as an expenses later. That means when the product is sold. At that point, they become the cost of goods sold. Let's talk about how production costs are used in business and accounting. First, inventory valuation. Production are part of your inventory, as we said before. This includes raw materials you haven't yet used, products still being made, which is work in progress, and finished products that are ready to sell. Second, gross margin analysis. This helps business figure out how much money it really makes from its products. You calculate gross margin by subtracting production costs from the sales revenue. It tells you if your pricing is good and whether your product is profitable. Third, production volume. Production cost goes up or down depending on how much you produce. If you make more items, you spend more materials and labor. If you make fewer, you spend less. This makes production costs somewhat flexible. Let's bring this to life with an example. Imagine a company producing laptops incurring costs that are capitalized in inventory. The costs only become expenses when they're sold as cost of goods sold. Of course, when we produce, it's part of inventory. When we sell, it become cost of goods sold. We have direct materials for 204 parts like screen, keyboards, and direct labor for $100 for the wages of workers, assembly, and $50 as manufacturing overhead for things like electricity, tools, and factory rent. So the total cost to make one laptop is $350. But remember, they don't record the cost as an expenses immediately. Instead, it goes into inventory. Later, when the company sold this laptop, it's become cost of goods sold, which is part of the income statement. This process helps much cost to sales so we cannot record cost of goods sold without having sales. For that reason, it will be booked as inventory. Then when it's sold, it will be part of the cost of goods sold, and we have the sales revenue and cost margin, and we have appropriate profit for the period. Now let's move to the period costs. Those are the costs that doesn't have anything to do with making the product. Instead, they are just related to running the business. For example, rent for your office or advertising cost. They are not stored in inventory. Expenses tied to a specific accounting period, not production volume. They are immediately recorded as expenses when incurred. There is no capitalization. They show up in the income statement as operation costs, not in the cost of goods sold. There are two big types of period cost. First, selling expenses and administrative expenses. Selling expenses, those are related to advertisement, marketing materials, delivery expenses, and sales commission. These costs will be incurred during the period and shown directly in the operation expenses of the company. Then we have administrative expenses. These are general costs of running the business. Example, office salaries, headquarters rent, legal fees, and accounting services. Think of it this way. If the cost helps run the company but doesn't help make the product, it's probably a period cost. Let's use the same laptop company we talked about before. In addition to building laptop, the company also need to promote them and pay office staff. The company, they spend 5,000 for as marketing expenses every month on online ads, brochures, and other promotional efforts. The company, they spend 10,000 US dollar every month in office salaries. These period costs are expenses each month, regardless of how much laptops are produced or sold. So the company will record these costs right away in their income statement as operational expenses. They are not part of product cost or inventory. To finish up, let's do a quick comparison between production and period cost. We have criteria manufacturing related, it's production cost, and this is not period cost. Capitalize as inventory. So for production costs, of course, we need to capitalize these costs, and is not period cost. And we said that period costs only when the cost not related directly to the material, to the manufacturing. And when expenses, it will be often shown as cost of goods sold. This is, we record expenses only when we sell the product. It will be shown in the cost of goods sold. And in the period cost, the expenses will be shown incurred and direct impact on the gross margin.